Look, I need you to pay very close attention to what I'm about to tell you because what's happening right now in the precious metals market is something most people won't see coming until it's too late. And by too late, I mean the window of opportunity will have completely closed. Right now, as I'm recording this, dealers across the country are reporting something that should send chills down your spine. Their inventory is vanishing. Not slowly, not gradually. We're talking about a complete evaporation of physical metal that's happening in real time. And here's the kicker. They're telling their most trusted clients that within 72 hours, the supply situation is going to reach a critical breaking point. Now, I know what you're thinking. You've heard supply shortage stories before, but this is different. This isn't some manufactured crisis or marketing hype. This is dealers, the people who actually move physical metal, privately warning their clients that something unprecedented is unfolding. Let me paint you a picture of what's actually happening on the ground level. I've been talking to dealers and they're describing scenes they've never witnessed in their entire careers. One dealer told me that a client walked in wanting to buy 500 ounces of silver. Standard transaction, right? Except the dealer had to tell him they could only fulfill 50 ounces. And that remaining 50 ounces, that was their entire inventory. A dealer who normally keeps thousands of ounces on hand was down to 50. But here's where it gets really interesting. This isn't just about retail investors suddenly waking up and buying metal. That's part of it, sure. But the real story is what's happening at the institutional level, and it's something that should terrify anyone who understands how these markets actually work. The COMEX, that's the commodity exchange where precious metals futures are traded, is experiencing something extraordinary. We're seeing massive withdrawals of physical metal from their vaults. We're talking about millions of ounces leaving the system. And when I say leaving, I mean it's being taken into private hands and it's not coming back. Now, let me explain why this matters. The COMEX operates on what's essentially a fractional reserve system for precious metals. They have paper contracts representing far more metal than actually exists in their vaults. It's a system that works perfectly fine as long as most people are content to trade paper and never actually demand physical delivery. But when people start standing for delivery, actually demanding the physical metal their contracts represent, the whole system starts to crack. And that's exactly what's happening right now. The ratio of paper claims to physical metal has reached levels that are mathematically unsustainable. Think about it like this. Imagine a bank that issued 100 deposit slips but only kept $10 in the vault. Everything's fine until people start asking for their money back. That's the precious metals market right now. But let's dig deeper into why this is happening now. What's driving this sudden surge in demand for physical metal? It's not just one thing. It's a perfect storm of factors that are all converging at the same time. First, you've got central banks around the world buying gold at a pace we haven't seen in decades. And I'm not talking about small purchases. We're talking about hundreds of tons. China's central bank has been on an absolute buying spree. Russia, despite all the sanctions and international pressure, has been accumulating gold like there's no tomorrow. Even countries that traditionally held mostly dollars in their reserves are diversifying into gold at unprecedented rates. Why? Because they see what's coming. They understand that the dollar's dominance as the world's reserve currency is being challenged in ways it never has been before. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working on alternatives to the dollar for international trade. They're not just talking about it anymore. They're implementing it. And when you're moving away from the dollar, what do you move into? Gold, physical gold. But here's what most people miss. It's not just about countries buying gold for their reserves. It's about the entire architecture of global trade being restructured. For decades, if you wanted to buy oil, you needed dollars. If you wanted to engage in international trade, you needed dollars. The dollar was the universal medium of exchange. But that system is breaking down, and it's breaking down fast. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting payment for oil in currencies other than dollars. Think about what that means. The entire petrodollar system, which has been the foundation of dollar dominance since the 1970s, is crumbling. And when that system breaks, what becomes the universal store of value? Not paper currency. Physical precious metals. Now let's talk about what's happening in the silver market specifically, because silver is where this supply crisis is most acute. Silver is unique because it's both a monetary metal and an industrial metal, and the industrial demand for silver is exploding in ways that most people don't fully appreciate. Solar panels require silver, Electric vehicles require significantly more silver than traditional cars. 5G infrastructure requires silver. The green energy transition that governments around the world are pushing, it's incredibly silver intensive. We're talking about industrial demand that's growing exponentially while mine supply is essentially flat or declining. But here's the really crazy part. Unlike gold, most silver that's used industrially is consumed. It's gone. It's not sitting in a vault somewhere waiting to be recycled. It's used in tiny amounts in electronics, in solar panels, in medical applications, and it's economically unfeasible to recover it. So that silver is permanently removed from the available supply. Now combine that industrial demand with investment demand. You've got industrial users competing with investors for the same limited supply of physical metal. And guess what happens when you have increasing demand and flat or declining supply? Basic economics tells you the price has to go up. But the price isn't reflecting that reality yet. Why? Because of the paper market. The paper market, the futures contracts, the ETFs, the derivatives, has been suppressing the true price of silver for years. But that suppression can only last as long as there's physical metal available to deliver against those paper contracts. And that's where we are right now. The physical market is starting to break away from the paper market. Dealers are reporting premiums. That's the amount above the spot price that you pay for physical metal, that are reaching levels we haven't seen since the chaos of 2020. But this time, it's not pandemic-driven panic buying. This is structural. This is the market recognizing that physical metal is becoming genuinely scarce. Let me tell you about something that happened recently that perfectly illustrates what's going on. A major bullion dealer had to temporarily suspend taking new orders because they literally couldn't source enough metal to fulfill the orders they already had. This is a dealer that's been in business for decades, that has relationships with mints and refineries around the world, and they had to stop taking orders because they couldn't get metal. Think about what that means. The supply chain for physical precious metals is breaking down, and when a supply chain breaks down, prices don't just go up gradually. They spike, they gap up, because suddenly you have buyers who are willing to pay almost any price to secure physical metal, and there are no sellers. Now, I want to talk about something that's relevant if you're thinking about your retirement security. If you have significant retirement savings, and I'm talking about folks with 6 figures or more in retirement accounts, you need to understand how precious metals can fit into that picture. A gold IRA allows you to hold physical precious metals inside a tax-advantaged retirement account. I put together a comprehensive guide that walks through exactly how this works, how to do it without triggering tax penalties, and what you need to know. It's completely free, and you'll find it in the description below. If you're sitting on substantial retirement savings and you're concerned about what we're discussing here, it's worth taking a look at. But let's get back to the immediate situation, because the 72-hour timeline I mentioned at the beginning isn't arbitrary. Here's what dealers are seeing. They're getting allocation notices from their suppliers, the mints and refineries that produce physical metal, saying that current orders will be fulfilled, but new orders are going to face significant delays or may not be filled at all in the near term. What does that mean in practical terms? It means that the metal that's currently in the distribution pipeline, the metal that's already been produced and is sitting in dealer inventory or in transit, that's it. That's what's available. Once that's gone, there's going to be a gap between when metal is ordered and when it can actually be delivered. And during that gap, prices are going to do things that will shock people who aren't paying attention. Let me give you some historical context, because this isn't the first time we've seen supply disruptions in precious metals markets. Back in 1980, during the Hunt Brothers silver squeeze, the price of silver went from around $5 an ounce to over $50 an ounce in a matter of months. Now, that was a different situation. That was market manipulation by a couple of billionaires trying to corner the market. But the underlying dynamic was the same. A recognition that physical supply was limited and a rush to secure that supply before it was gone. Or look at what happened in 2008 during the financial crisis. Even as the paper price of silver was crashing, dealers couldn't keep physical metal in stock. Premiums exploded. People were paying 30, 40, even 50% over spot price just to get their hands on physical silver. The paper market said silver was cheap, but try actually buying physical metal at that price. You couldn't. The physical market had completely disconnected from the paper market. And here's what's different about right now compared to those historical episodes. In 1980, it was manipulation. In 2008, it was panic. But right now, this is structural. This is the market fundamentally repricing the value of physical precious metals relative to paper claims. This is the market recognizing that paper promises aren't the same as physical metal in your possession. Let's talk about what's happening in the mining sector, because that's another piece of this puzzle that most people aren't paying attention to. Mining companies are facing challenges that are making it harder and more expensive to produce metal. Energy costs are up. Labor costs are up. Environmental regulations are getting stricter. The easy-to-mine deposits have already been mined. New discoveries are in more remote, more challenging locations. What does that mean? It means that even if the price of silver or gold goes up significantly, it's not like miners can just flip a switch and produce more metal. It takes years to bring a new mine online. Years of exploration, permitting, construction, and during those years, demand continues to grow while supply remains constrained. There's also something happening in the mining sector that should concern anyone paying attention. Major mining companies are not investing in new production capacity at the rate they should be given the demand outlook. Why? Because they've been burned before. They've seen prices spike, invested billions in new capacity, and then watched prices crash. So they're being conservative. They're returning cash to shareholders instead of investing in new mines. That's rational from a business perspective, but it means that the supply response to higher prices is going to be muted and delayed, which means prices are going to have to go much higher to incentivize the production increases that are needed to meet demand. Now let's talk about what's happening with ETFs, exchange-traded funds that supposedly hold physical metal. These have been a popular way for investors to get exposure to precious metals without dealing with the hassle of storing physical metal. But here's the thing. When you own shares in an ETF, you don't own metal. You own shares in a fund that claims to own metal. And we're starting to see some concerning things happen with these ETFs. There have been questions raised about whether some of these funds actually have all the metal they claim to have. There have been auditing issues. There have been questions about whether the metal is allocated or unallocated and what that means for shareholders if there's ever a crisis. But more importantly, we're seeing outflows from some of these ETFs as investors decide they want physical metal in their possession rather than paper claims. And when metal flows out of ETFs, that's metal that's leaving the available supply. It's being taken into private hands and it's not coming back to the market. Here's something that should really make you think. The total amount of silver held in ETFs worldwide is a fraction of annual industrial demand. Think about that. All the silver held in all the investment vehicles in the world wouldn't even cover 1 year of industrial consumption, and industrial demand is growing. So where's that silver going to come from? The answer is it has to come from somewhere, either from new mine production, which as we discussed is constrained, or from recycling, which is limited, or from existing above-ground stocks. But here's the problem. Nobody knows how much above-ground silver actually exists. There are estimates, but they're just guesses. And a lot of that silver is in forms that aren't easily available to the market: jewelry, silverware, industrial applications. So you have this situation where visible, available supply is shrinking, demand is growing, and the market is starting to wake up to the fact that the emperor has no clothes. The paper market has been pretending there's plenty of metal available, but when people actually try to take delivery of physical metal, they're discovering that it's not there. Let me tell you about what some of the smartest money in the world is doing right now. Hedge funds that specialize in commodities are taking massive positions in precious metals. Not paper positions. Physical positions. They're buying metal and taking delivery. They're storing it in private vaults. They're treating it like the strategic asset it is. And it's not just hedge funds. Family offices, the investment vehicles for ultra-wealthy families, are allocating significant portions of their portfolios to physical precious metals. These are people who have access to the best financial advice money can buy, who have connections at the highest levels of finance and government, and they're buying physical metal. Why? Because they understand what's coming. They understand that we're in the late stages of a debt-based monetary system that's reaching its mathematical limits. They understand that when that system breaks, and it will break, it's just a question of when. Physical assets are going to be the only real store of value. Think about the debt levels we're dealing with. The U.S. national debt is over $35 trillion and growing by trillions every year. That debt can never be paid back in real terms. It can only be inflated away, and when you inflate away debt, you destroy the purchasing power of the currency. And when you destroy the purchasing power of the currency, people flee to hard assets, to things that can't be printed, to things that have intrinsic value. Gold and silver have been money for thousands of years, not because of some arbitrary decision, but because they have properties that make them ideal as money. They're scarce, they're durable, they're divisible, they're recognizable, they're portable. And most importantly, they can't be created out of thin air by governments or central banks. Every fiat currency in history has eventually failed, every single one. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created. And the pace of that purchasing power destruction is accelerating. We've seen more currency creation in the last few years than in the entire previous history of the country. What do you think happens to the value of dollars when the supply of dollars is increasing exponentially, while the supply of goods and services is growing much more slowly? Basic supply and demand tells you the value of dollars has to fall. And what do you think happens to the value of assets that have a fixed or slowly growing supply? Their value in dollar terms has to rise. But here's what makes the current situation so critical. We're not just talking about gradual inflation anymore. We're talking about a potential loss of confidence in the currency itself. And when confidence is lost, things happen fast. Very fast. We've seen it in other countries. We saw it in Weimar Germany. We saw it in Zimbabwe. We saw it in Venezuela. When confidence breaks, the currency can collapse in a matter of months or even weeks. Now, I'm not saying that's going to happen to the dollar tomorrow, but I am saying that the conditions that lead to that kind of crisis are being put in place right now, and the smart money is positioning for that possibility. They're not waiting until it's obvious to everyone. Because by the time it's obvious to everyone, it's too late. The metal is gone. The prices have already exploded. That's why this 72-hour window matters. Right now, you can still get physical metal. It might cost you a premium over spot price. You might have to wait a few weeks for delivery, but you can still get it. In 72 hours, based on what dealers are telling their clients, that might not be the case anymore. The supply that's currently available might be gone. And then you're waiting for new production, which could take months. And here's the thing about waiting. Every day you wait, the situation gets worse. Every day, more metal leaves the system. Every day, more people wake up to what's happening. Every day, the premiums get higher. Every day, the delivery times get longer. I want you to think about something. If you knew with certainty that precious metals were going to double or triple in price over the next year, what would you do? You'd buy as much as you could afford, right? Well, I can't tell you with certainty what's going to happen. Nobody can. But I can tell you that the setup we're seeing right now, the supply constraints, the demand surge, the monetary instability, the geopolitical tensions, this is the kind of setup that historically has led to explosive moves in precious metals prices. And here's the beautiful thing about physical precious metals. They're not someone else's liability. When you hold physical metal, you're not dependent on a bank staying solvent. You're not dependent on a government honoring its promises. You're not dependent on a company's management making good decisions. You own an asset that has been recognized as valuable for thousands of years and will continue to be valuable regardless of what happens in the financial system. Think about what happened in Cyprus back in 2013. The banks closed. People couldn't access their money. And when the banks finally reopened, the government confiscated a portion of deposits over a certain amount. Just took it. If you had your wealth in a bank account, you lost it. But if you had physical precious metals, nobody could touch it. Or think about what's happening in countries with capital controls right now. In some countries, you can't move money out of the country. You can't convert your local currency to dollars or euros. But physical gold and silver, that's portable wealth. That's wealth you can take with you if you need to. I'm not trying to scare you. I'm trying to wake you up to reality. The financial system we've all grown up with, the system we've been taught to trust, is showing cracks. Big cracks. And those cracks are getting bigger. The people who recognize this early and position themselves accordingly are going to be fine. The people who wait until everyone else figures it out are going to be scrambling to protect their wealth when it's already too late. So, what do you do? First, educate yourself. Understand what's happening. Don't just take my word for it. Do your own research. Look at what central banks are doing. Look at what the smart money is doing. Look at the supply and demand fundamentals. Draw your own conclusions. Second, if you decide that precious metals make sense for your situation, act decisively. Don't wait for the perfect moment. Don't try to time the exact bottom. If you believe the long-term trend is up, and the fundamentals strongly suggest it is, then getting in at current prices is going to look like a gift in hindsight. Third, focus on physical metal. Not paper promises, not ETFs, not mining stocks. Physical metal that you can hold in your hand or store in a secure location. because when the crisis comes, and it will come, paper claims are going to be worth the paper they're printed on. Physical metal is going to be priceless. The 72-hour window I mentioned at the beginning isn't about creating artificial urgency. It's about recognizing reality. Dealers are telling their clients that the supply situation is reaching a critical point. The metal that's available now might not be available soon. And once it's gone, you're at the mercy of whatever the market price is when new supply becomes available. This is one of those moments in history where the people who act early are going to be rewarded, and the people who wait are going to regret it. The signs are all there. The supply is evaporating. The demand is surging. The fundamentals are screaming that prices have to go higher. The only question is whether you're going to position yourself accordingly or whether you're going to watch from the sidelines and wish you had acted when you had the chance. The choice is yours, but choose quickly, because in 72 hours the landscape might look very different, and by then it might be too late.